All right, let's talk about something that's absolutely fundamental to understanding any business, big or small. We're talking about obligations, the debts a company owes to others. In the financial world, we call these liabilities, and trust me, they are a critical piece of the puzzle when you're trying to figure out a company's real financial health. So what do they truly tell us? Let's dive in and break it all down.
Here's the game plan for today. We're going to start with a really solid core definition of what a liability even is. Then we'll get into the three main types: the short-term stuff, or current liabilities, the long-term ones that are further out on the horizon, and the really interesting ones, contingent liabilities, the big unknowns. And finally, we'll pull it all together to see why this isn't just for accountants, but why it matters for anyone trying to understand a business.
Okay, so let's start with this simple but incredibly powerful question. When you look at any company, from a tiny startup to a massive corporation, what does it actually owe to other people and other companies? The answer to that, well, that's the very essence of a liability.
So if we want to get formal for a sec, a liability is any financial obligation a company owes to an outside party. Think of it like this. It's a claim that someone else has on the company's assets. It's a promise of a future sacrifice. This debt has to be settled down the road, and yeah, that's usually with cash, but sometimes it could even be with goods or services.
Now, and this is important, not all debts are created equal. They exist on different timelines. First up, we've got current liabilities. These are the short-term obligations. You know, the bills that are basically knocking on the door right now and need to be paid within the next year.
So what does this look like in the real world? Well, we're talking about things like accounts payable. That's just the money you owe your suppliers for materials. It's also the wages you owe your employees for the work they've already done, and those regular accrued expenses, like your monthly utility bill or the taxes you owe the government. This is the stuff that keeps the lights on and the daily operations running.
And the implication here is huge. Getting this right, managing these short-term debts effectively, is what keeps the gears of the business turning smoothly. If you fail to manage this cash flow, if you can't pay your suppliers or your employees on time, the whole operation can grind to a halt. We're not just talking about avoiding late fees. This is about immediate financial survival.
All right, let's shift our focus. If current liabilities are all about the here and now, long-term liabilities, they're all about the future. These are the big financial obligations that don't need to be fully paid off for at least another year, and often much, much longer.
Here, we're talking about the big-ticket items. Think about a mortgage on a new factory or headquarters, or a multi-year bank loan you took out to buy a whole new fleet of equipment, or even bonds that you issue to the public to raise a ton of capital for some massive new project. These are debts you take on with a long-term vision.
And that's the crucial point. These kinds of debts aren't for paying the day-to-day bills. They are strategic tools. Companies use them to finance significant growth, to build new facilities, to push into new markets, or to invest heavily in R&D. You could say this is debt being used as an engine for expansion.
So this table really lays it all out nicely. You've got current liabilities, due within a year, all about daily operations. They have a direct impact on a company's immediate cash flow, its liquidity. Then, on the other side, you've got long-term liabilities. They're all about investment and expansion, and they give us a much better picture of the company's long-term stability and solvency. Two different purposes, two different impacts.
Okay, now let's dive into what is, for me, the most fascinating category: contingent liabilities. These are the great what-ifs of the financial world. They aren't definite debts just yet. Instead, they are potential obligations that might or might not pop up depending on how some future event plays out.
The classic example here is a pending lawsuit. The company might have to pay out a huge settlement, or it might win the case and pay nothing. It all hangs on the court's decision. Other common examples are things like product warranties, the potential cost of fixing a bunch of faulty products, or maybe future environmental cleanup costs that could be required if new regulations come into play.
So you're probably wondering, how on earth do you account for something that might happen? Well, accountants actually have a pretty clear process. First, they identify the potential event. Then they have to assess the probability of it actually happening. After that, they have to try and estimate the potential financial damage. And here's the key. If that loss is considered probable and the amount can be reasonably estimated, then it absolutely has to be disclosed in the financial statements for everyone to see.
And that's precisely why these matter so much. A massive potential lawsuit or a huge number of warranty claims can be a major red flag for investors. These what-ifs provide a crucial window into the hidden risks a company might be facing, and they directly affect how the market perceives its overall health and stability.
Okay, so let's bring it all home.
Looking at all these different types of liabilities, it's not just some boring accounting exercise. It's really about understanding the complete story of a company's obligations, what it owes right now, what it owes in the future, and what it might owe down the road.
When you analyze a company's liabilities, you learn so much. You see how it funds everything, from paying the light bill to building a factory. This is how we gauge its financial stability and the risks it's taking. And it's a core piece of really important metrics, like the debt-to-equity ratio, which makes it absolutely vital information for any smart investment decision.
Which leaves us with one final critical question. Because understanding what liabilities are is one thing, but evaluating them is a whole other ballgame. How much debt is too much? There's no single magic number. It really depends on the industry, the company's strategy, the economy. But simply asking that question, that is the first real step toward true financial insight.